All right, folks, I am very sorry for the delay. This has been a very interesting day in the fact that I was planning on focusing on my classwork, and then had like multiple people come to me with administrative stuff that I had to focus on. I just got done with a call with a professor at another university about a reference check for a faculty hire we're having, and I realized none of that's relevant. I just wanted to know I had an excuse. I apologize. Let's go ahead and get started. Real quick, I do not anticipate that we will have a class or campus closure next Wednesday or this coming Wednesday for the exam. If we do, we will reschedule. I'm not sure exactly how that will affect the rest of the schedule, but we'll figure it out. That being, my plan is for Wednesday, we will be here in this classroom at 1:30 to take an exam. So when you come here, I recommend you show up a few minutes early because I do try to start the exam a little bit early, just to give you a little bit extra time. Show up with pencil and paper, or pencil and eraser, not paper, pencil and eraser. If you bring a pen, you're welcome to try to do the exam like that. It just makes it really difficult to change your answer, and frequently people change answers. I would bring a calculator. You cannot use your phone as your calculator. You will need to have your own calculator because people can look up answers on phones. I would encourage you to bring your real calculator and then a backup calculator. One of those cheap things you get as a gift from one of the accounting firms. Say, come and thank you for visiting our booth. That way you just have a backup just in case. And then real quick, as far as the content of the exam goes, all 5 chapters will be covered in varying degrees. There will be one multiple choice question on chapter 1. There will be another multiple choice question on chapter 2. And then basically 3 each on the next 3 chapters, chapters 3, 4, and 5. I say basically in that one of them will have an additional multiple choice question, but I'm not going to tell you which one. I'm just going to say that they're basically equal coverage. That will comprise the 12 questions that are on the exam. As far as the problem goes, the problems will be like similar to the practice exam. It will cover content from chapters 4 and 5, which is kind of the most relevant content. So focus on that for your problem studying. All right. As promised, I'm going to go through the study guide. I am going to go through it laser quick, even more laser quick than I did before. Is that a word or term? Laser quick? Okay. Very, very quick. Very fast. I'm going to cover some things that I think are important. If there's something I don't cover or that is something I cover, but you need more detail on, raise your hand saying, can you clarify that and explain that a little bit more detail? And I'd be happy to do so. All right. So we talked about the nature of nature of auditing and where it comes from. It emanates from the principal-agent relationship. There's an aspect to information with respect to principal-agent relationship that's not in the study guide, but it's a very important definition that auditor tries to mitigate. Does anybody remember that term? Information asymmetry. Information asymmetry. We are trying to mitigate information asymmetry between principals and agents. All right, management assertions, we'll get more into detail on these, but you will obviously need to know these. These are going to be a focus of the exam, so making sure you know these in detail. By the way, when I say know something, I am not saying memorize those words, okay? I'm not saying memorize those terms. You do that, you will still get questions wrong. When I say know something, you start by memorizing what they all are, then you actually learn the definitions, and then you figure out how they're used in every context. So this is one of the most important things you're going to learn in this course. Start now, get it down really, really well so that when you use it in the future, which we will use it many times in the future, you'll have it down. So know these really, really well. Real quick. We're going to talk about this here in just a second. The assertions about transaction events, that's basically everything but rights and obligations. And then the assertions about account balances at period end, that's basically everything but cutoff and authorization. Which authorization is not a real assertion, but will count as a real assertion just to make it feel special. And so please make sure you remember those. Keep that in context. We talk about transactions events. Those are day-to-day operations of the entity. We talk about account balances. That's what's reported in the financial statements, financial reporting presentation purposes. 3 fundamental concepts of conducting an audit of financial statement. In the past, I've asked a question about this and students got very confused. So just make sure you remember these. We talk about these at length in the next chapters. And in fact, these actually align to the 3 chapters. Materiality is chapter 3, audit risk is chapter 4, evidence is chapter 5. Something we did not go into a lot of depth, but please make sure you have at least a preliminary understanding of is the 4 types of audit reports. We have talked about those multiple times already. Our biggest conversation of those was in chapter 1. There were 4 slides on those that talked about the nature of the reports and what it is you should look for each one. Unqualified is our clean opinion. That means everything is cool, all right? That's also called an unmodified report when we talk about it for ASB purposes. Qualified is basically saying everything is cool except for one or two things, okay? Two words that we're looking for are the word except for. Adverse is saying that there's a material misstatement. The financial statements are materially misstated. Disclaimer of opinion is saying we don't know what's going on because we couldn't do our job properly. We will get into a lot more depth in those in chapter 2, but I will expect you to have some understanding of those, or sorry, for the exam 2. But I expect you to have some understanding of those for exam 1. Something to know real quick. We did talk about the phases of the audit. Something that's really fundamental for your understanding for this particular test is understanding what phase of the audit you are in at any particular time. Okay. So the phases of the audit, we talked about planning and risk assessment, test of controls, and substantive procedures. All right. Make sure you know when you're answering a multiple choice question what phase of the audit it deals with. You do need to be very, very aware of that because that's going to be very relevant to the type of question that's being asked. Also, it's important to note that we can gain assurance in some phases and we can test assertions in some phases. When we talk about testing assertions, those are primarily limited to test of controls and substantive tests. Talk about gaining assurance, we can also include those plus risk assessment. But those will all be relevant to filling the assurance bucket or the assurance Chipotle burrito, whichever you prefer. All right. That's it for chapter 1. Chapter 2, again, there's only one multiple choice question here, so it's a very short chapter. We went through it kind of as an afterthought. I will tell you right now that it's going to come from basically 2 slides near the end of the lecture, because we did the chapter 1 and chapter 2 lecture the first week. And there were 2 slides at the end that talked about the auditor responsibilities. I would know the definitions of all these terms: due professional care, professional skepticism, and reasonable assurance. And then understand how ethics and professionalism relates to our profession and what is the code of professional conduct. Okay. I will tell you 100% certainty the question that's on the exam will come from one of those areas. So make sure you're familiar with all those areas there. All right. Client continuance or acceptance. Okay. So remember, client acceptance, we talked about some procedures for understanding whether or not we want to accept a client. Have a general understanding of those. I would have a more detailed understanding of client continuance. There are basically 2 reasons why an auditor might leave an existing client. All right, 2 reasons. First of those is there's a contentious relationship with a client. If basically you're always fighting with the client to get things done. The other reason is if there's disagreements about audit fees. Okay, any one of those 2 can cause us as auditors to say, "See ya." All right. Those are general reasons. There may be more specific reasons. We talked about an example of engagement risk in chapter 4. That's another possible reason that doesn't exist within that scope. But for the most part, we're only going to focus on those 2 particular concerns, whether or not there's a contentious relationship or there's disagreements disagreements about audit fees to the client. Primary sections of the engagement letter. There are 3 primary sections that we talked about. This is not to say that an engagement letter only has 3 sections. It says that every engagement letter should contain these 3 sections. So what are those 3 sections? There's going to be the objectives and scope of the audit, the auditor's responsibility, and management's responsibility. Okay. Going beyond that, please make sure you're aware when I say what is management's responsibility and what is auditor's responsibility, you know the difference between those. Management's responsible for the presentation or for the preparation and fair presentation of the financial statements, as well as the design, implementation, and maintenance of internal controls. Auditors are responsible for testing those things. It's a lot more detail to it than that, but that's basically what you need to know for now. Okay. Understanding and testing those items. All right. A little bit later down, it talks about audit strategy, the scope of the engagement, reporting objectives, and the focus of the audit team's efforts. All I'm going to tell you is that there's a big summary here on this slide right here. This is chapter 3, slide 11. Talked about a lot of concepts here. I would make sure that you know these, at least at a basic level, what all these represent. I kind of debriefed you on all these. The ones that are that are bolded, we talked about in detail. The ones that are kind of just listed here, I talked about them at a very basic level, but I would just be familiar with those and understand that these are all parts of an audit strategy and start developing the audit strategy. Or sorry, develop the steps in audit planning. My apologies. There's a difference there. So please make sure you take a look at that slide. Study guide. All right. With respect to related parties, one of the criteria for related parties is that related party transactions generally do not occur at arm's length. Does everybody remember what that means when I say they do not occur at arm's length? So arm's length transaction is characterized by transactions in the ordinary course of business with another party. Generally, you settle on an agreement, you shake hands. That's arm's length transaction. Related party transactions are not considered to be arm's length, they're closer than that. Okay. Phases in testing, we just talked about that. Make sure you're familiar with all the phases of testing. We just went through those. That's very important. I can't emphasize that enough. Make sure you know all phases of testing. There's going to be more to it than just the phases of testing, but for right now, make sure you know each of these and what sequence they occur in. Steps in planning materiality to audit. I will use, if I do a question on this, I'll give you some very specific guidelines, but I would refer back to the Willis and Adam materiality guideline steps. Remember, there was that document associated with the spreadsheet. You might want to reread that just to make sure you have some basic understanding of how materiality is assessed at the planning level and the tolerable misstatement level. Also, in determining planning materiality, we talked about quantitative and qualitative bases. And there always seems to be some confusion in this area. So let me go ahead and specify what you need to know in this, okay? When we talk about the quantitative base, we're talking about, first of all, what is the base that we're going to use, whether that's pre-tax income, total assets, total revenues, whatever it is, okay? All right. So that's going to be defining the base based on the criteria of the client. The qualitative base represents adjustments to that base, okay? So say, for example, I use 5% of pre-tax income as my quantitative base. Qualitative factors that might go into this would represent risk factors that might say, I want to use a lower percentage because I'm more concerned about risk, okay? Example of this is if a client has material misstatements in a previous audit. That would represent a qualitative factor that might say, all right, I'm going to use a lower percentage because I want to make sure that my materiality is sufficient to address this risk. So make sure you understand the difference between a quantitative base, which is basically our determination of whatever the percentage and the base the metric's going to be, and a qualitative factor, which is going to adjust those numbers. All right. And so those will both be relevant in that determination for materiality. All right, moving down, audit risk model. You probably guessed from the practice exam, but you need to know a lot about audit risk. I think the practice exam did a pretty good summary of that problem, of the kind of things that I would be looking for on there. Make sure you understand the audit risk model. You understand the relationships between inherent risk, control risk, and detection risk. And then you can actually make determinations based on the factors present. So if I give you what the assessments of inherent risk and control risk are, you should be able to determine what detection risk are and what that means for all subsequent testing, okay? And yeah, there's that. As far as risk assessment procedures go, we're going to talk more about this in evidence, but I do want to talk a little really quickly about this. I did spend some time on this in chapter 5, going through what type of evidence can be collected during what phase of the audit. There was a high likely chance I will ask you that again on the exam. So these are the 4 types of evidence you can collect during risk assessment procedures. So be sure you understand those. So obviously, you need to know what the types of evidence are as well, but you do need to know that these can be collected during risk assessment. I should probably have clarified when I said analytical procedures that these are preliminary analytical procedures during risk assessments, not just regular analytical procedures. When it gets to test of controls a little bit later on, you'll need to know the types of evidence that can be collected there. That's inspection of records of documents, observation, inquiry, reperformance, and walkthroughs. And the substantive procedures are easy because you can collect any type of evidence during substantive procedures, all right? But I do expect you to know all that. All right. So categories of fraud, be able to define each type. When I have say be able to define each type, I do expect you to know the difference between those. So you need to understand the difference between fraudulent financial reporting and misappropriation of assets, and at least provide a simple definition of each. Misappropriation of assets is easy, it's theft, okay? Fraudulent financial reporting, that's misrepresentation of the client's financial position. That's pretty straightforward there. I have traditionally asked one question in many years on the differences between factual, judgmental, and projected misstatements. I know that's only one slide in chapter 4, but you might want to go back and review that slide to make sure you understand the difference. I provide a couple of examples, or I shouldn't say, I provided 3 examples, one for each of these that help clarify the difference between those types of judgments, those types of misstatements. Fraud triangle. These are considered to be the fraud risk factors, or conditions that are indicative of fraud. This is kind of a throwback to AIS. I would expect you to remember that from AIS, but it's still really important for what we talk about here in auditing. Please make sure you understand the difference between those and apply them as necessary. And by the way, which one did we determine that as auditors we have the most control over? Does anybody remember? So incentive, pressure, opportunity, or rationalization. Opportunity. Yeah, we can't really control what other people do, but we can control what our client does. Okay. So we can control opportunities present in client. This might be through good controls or more detailed work with over the course of the audit to detect problems. All right, conditions and communication and misstatements or fraud. So when we talk about communication of fraud, all fraud is considered to be reported to the next highest level of management. So say, for example, you have people who are stealing parts on the assembly line, you'd want to report to whoever the manager of the assembly line is that the fraud is occurring, that you detected that. So basically, we go to the next highest level of management in reporting the fraud. The only issue, the only time that does not exist is if we're talking about a fraud that occurs at the executive level, like Enron, for example. If the executives are the ones committing the fraud, we can't really go to the executives and say, hey, you're committing a fraud, do something about that. All right. In that case, we report directly to the audit committee. Okay, so that's what's unless the management is the source of the misstatement of fraud, we do need to talk to the next highest level of fraud or next highest level of management. And we obviously can't do that if the manager is the one committing the fraud. So we go to the audit committee directly. All right, back to management assertions. Again, make sure you know all the assertions. And like I said, knowing is not just memorizing the words. Make sure you can apply them in different situations. The two categories of relevant assertions, the relevant assertions for each. Remember, transactions, events, and account balances. Know each of the assertions that are listed there. Make sure you understand those. Concepts of audit evidence. Some important ones that we listed out. Talk about concept of audit evidence. So nature, which is sufficiency, or nature is one of those. Then sufficiency and appropriateness were two listed together. Appropriateness has factors of relevance and reliability. And remember, appropriateness is quality, where sufficiency is quantity. And then the evaluation audit evidence, basically we're trying to determine, is it better than any other evidence that we could get for that particular type of information? All right. I've already talked about the phases of audit testing. I'm going to reiterate this point again. When we talk about the phases in testing, please make sure you are very aware of what type of evidence you can collect at various phases. Risk assessment was inspection, records, documents, observation, inquiry, and preliminary analytical procedures. Test and controls, inspection, records, documents, observation, inquiry, reperformance, and walkthroughs. Substantive procedures, all types of evidence. Okay. I promise I won't repeat that again, but the reason I repeat it multiple times is because it's important. Types of evidence. All right, here's the big deal, guys. There's basically going to be multiple things you need to know with respect to types of evidence, and it reiterates the thing that we went over last Wednesday. So everybody remember we were in the room and I asked everybody to provide a little bit of an example of pieces of evidence, and I said, what is the assertions that are tested? What is the reliability? What is this type of evidence? Things along those lines. You are responsible for all of that information that we covered on Wednesday, okay? So that means what types of evidence can be collected using this particular type of information. What is the level of reliability? What phases of the audit can it be used? We've gone over that in class. We reiterated that point, and I talked about it multiple times. Make sure you know that for every type of evidence. In addition, you probably want to have a good idea of what each type of evidence is, because we defined each type of evidence. There are 10 types of evidence, okay? 2 of those are a subset of one of the others. Vouching and tracing are specialized versions of inspection records of documents. So technically only 8 types of evidence, but you do need to know all of this information. So just to reiterate, you need to know all the different types of evidence. You need to know which management assertions they can test. You need to know what level of reliability they represent, and you need to know what phases of the audit they can be used. All right. I know that's asking a lot, but trust me when I say we're going to be using this time and time again throughout the course. So it's a lot of information that we need to know. If you have that, you should feel pretty good about where your knowledge is and evidence. If you don't know that, it's going to be a rough ride. It's going to be a rough ride. By the way, I said that existence, occurrence, and completeness are characterized by directions, okay? So if I were to say vouching is a top to bottom test or a bottom to top test, which is correct? Top to bottom. Yep. Remember the V is pointing down, okay? And then tracing by contrast is going to be a bottom to top test, okay? I will say you can use that as a cheat. If you remember, vouching has got the arrow pointing down. It's got the little arrow in the V pointing down, and tracing is the arrow pointing up. But you still need to explain those. Still need to be able to explain those. All right. With respect to the audit documentation, function of documentation, please make sure you know the 3 primary functions: support the audit report, aid in planning and performance and supervision of the audit, provide a basis of the review. If you forget all of that, just remember the 3 words: support, aid, and review. Okay, so that's an easy way to remember those. Then you can kind of intuit wherever you need to go from there. Function for the formatted documentation. This is the thing that I said I think is the most important with respect to documentation. What formatting goes into documentation? Please make sure you know all of these elements and what they represent. Remember, the header is the stuff that goes to the top and the center of the paper and the upper right. Tick marks are like an index, or sorry, not tick marks. Index is like an index in a book. Tells you what the page is basically. Cross-referencing is saying referring page numbers to one another within the documentation. Then tick marks are shorthand notations to say what happens in the documentation. Let's go ahead and move down to the bottom. So you will need to be responsible or be capable of preparing analytical procedures similar to the one that we worked in class. I will say that the one that we did for the lecture is more likely to be represented than the one that we did for homework. That homework one was a nightmare. I would not do that to you on the exam, so don't worry about focusing too much on the homework analytical procedure. That being said, I won't necessarily ask you something we've done already. I won't necessarily ask you to do interest expense or some other calculation like that. You may have to do a calculation of something that you learned back in 302 or 303, but I promise you it will not be something that's outside of your capability. The one thing you do need to remember is when you're doing decision process for substantive analytical procedures, you do have to have a quantitative basis for your decision. Does anybody remember what that's called? If we're using, I guess I should say, if we're doing an estimate analytical procedure. It's called tolerable difference. You need to know how to calculate tolerable difference. And then how do we use tolerable difference to determine if a analytical procedure estimate is appropriate for a particular situation? We talked about that a couple times already, so go back and review that. How do we use tolerable difference in that situation? Real quick, I'm going to make sure that you remember this this point. So the EWC assignments, I would go back and review those. Particularly the materiality work papers and the inventory testing, since those were fairly quantitative in nature. Make sure you understand the quantitative protocols that were done in there, so you understand what it is that you did in each of those situations and the procedures. All right. For the materiality work papers, make sure you understand the difference between calculating planning materiality versus the assignment of tolerable misstatement. Make sure you understand the rules that are associated there. For inventory testing, make sure you know the protocols and the differences between floor to sheet testing and sheet to floor testing and what assertions can be tested in either scenario. And that pretty much does it. Are there any questions? Well, let's do the exam then, the practice exam. All right. I hope I got the right practice exam. We'll see what happens. All right. Listed below are the 4 types of opinions that can be issued in a public company accounting oversight board audit report. Which of these opinions is referred to by a different term for the ASB audit report? All right, so I told you guys right away that you would need to know something about the audit reports. So which of these has a different terminology with respect to ASB, which uses a different term? The others are exactly the same for ASB and PCOB, but one of these is not like the other. It is D, unqualified opinion. It's called an unmodified opinion for the ASB audit report. All right, what is the name for the set of rules created by the AICPA that detail the ethical and professional responsibilities for public accountants and in particular auditors? Remember I said that there were a limited number of things in chapter 2 I'd ask about? This is one of those things. What was that thing called? Does anybody remember? It's the Code of Professional Conduct. The Code of Professional Conduct. Very good. Which of the following tasks should an auditor complete as part of the determination of whether to accept a prospective client for an audit engagement? All right. So this is important to note. This is a phase question. So we know that we are in the planning phase of the audit. So we're going to talk about things that are outside of the planning phase and things in the planning phase. So document the necessary scope of substantive testing. When does substantive testing occur in an audit? Closer to the end, okay? We can't do that until we get closer to the end. We actually have to have test of controls completely done before we can actually determine how much substantive testing we're doing. So we're much further to the end of that. Evaluate the operating effectiveness of clients' internal controls. Does it make sense that if we're going to evaluate operating effectiveness of controls that we actually need to test those controls to do that? If it doesn't make sense, raise your hand. I'm hoping that that was a rhetorical question more than anything. Okay, so we do need to actually test controls in order to be able to do that. So we're not at that phase yet. Make certain inquiries to the predecessor auditor. Does that sound like a planning step? It is indeed a planning step. So C is probably our answer, but we request the client's legal counsel provide information about any unrecorded contingent liabilities the attorney is aware of. That is something we're going to talk about, but it's not a planning phase step. That's a very end of the audit step. So all of these occur close to the middle to the end of the audit. This is the only thing that occurs at the beginning of the audit. C. Consider the items listed below. Which of these are factors that an external auditor must evaluate when assessing the reliability of the internal audit function? What do you guys think? Competence, is that one? Yes. Do professional care? It's important for an auditor to have, but not something we evaluate for the external auditor or through the internal auditor. Objectivity. Yes. Value. We'd love her to be a value, but that's not one of the things we're concerned about. We're concerned about competence, objectivity. So that's going to be 1 and 3, which is B. I left one of them out. Does anybody remember what the third one is? Systematic and disciplined approach. That's something else we will also evaluate. So keep an eye out for that as well. Which of the following statements regarding audit committees is correct? An audit committee is comprised of a subset of all the entity's shareholders and creditors. No, it's comprised of a subset of the board of directors, not all the entity's shareholders and creditors. Audit committee for a publicly traded company that is subject to regulation under SOX must be comprised entirely of financial experts. And that is not correct. How many financial experts do they need? They need 1. Okay. An audit committee for a publicly traded company that is subject to regulation under SOX must contain at least 1 member of company's management. No, all members must be outside and independent, so they can't be members of management. There are no specific composition requirements for audit committees of privately held companies. That is the only one left, and that is a correct statement. These are all rules for publicly held companies, but private held companies do not have those rules. There's no guidelines on audit committees for privately held companies. There's not even a rule that they have to have an audit committee, which is kind of scary. As a general rule, an auditor calculates planning materiality at 5% of pre-tax income for its audit clients. In which of the following situations might the auditor use an amount other than pre-tax income as its basis for planning materiality? Is this a quantitative or a qualitative question? This is a quantitative question. I'm asking about the quantitative base. We're going to use something other than pre-tax income. Client is a privately held, profit-oriented company. Okay, so this is a quantitative answer. But if it's a privately held, profit-oriented company, wouldn't income before pre-tax income or pre-tax income be perfectly sensible? So I would use pre-tax income in the situation of A. The client operates in a mostly unregulated industry. So yeah, that's a risk factor that we would have to concern ourselves with, but that's a qualitative characteristic that might require an adjustment to the percentage, but it would not change the percentage that we operate in. Client has had material misstatements in prior year audits. That's another qualitative factor. That's a big risk factor, by the way, a big risk factor. That's one where we'd say we probably want to make that percentage lower. Client is a financial services firm or a mutual fund. Okay. In this situation, would it be appropriate to use income? Probably not, because their primary business model is based on the large amount of assets they hold. So we'd probably want to use assets as the basis for evaluation. So yeah, D is our answer. Auditor may be exposed to financial loss or damage to his or her professional reputation from litigation, adverse publicity, or other events arising in connection with audit financial statements. What is the term for this type of risk? Does anybody remember this? We talked about it. We had a pretty graphic example of this. It's engagement risk, B. Yeah, engagement risk. Question number 8, Chris's hypothesis. So there's a section underlined says, are aware this problem can be secretly resolved by the violation of the position of financial trust. So we're talking about 3 fraud risk factors. Remember, our 3 fraud risk factors are going to be pressure, opportunity, and rationalization. Corruption is a form of fraud that we're not talking about, so we can ignore A. Which one is the one that's underlined? Is it pressure, opportunity, or rationalization? Or opportunity, pressure, or rationalization, I should say. It is B, opportunity. Okay. Auditor decides to test a sample of client sales transactions to ensure that sales were recorded in the proper period. Which management assertion is the auditor testing? This should be a pretty easy question because this is exactly defined as the assertion that I'm asking about. Which assertion relates to making sure that transactions are recorded in the proper period? Cut off, yeah, B. I appreciate the scissors, by the way. That was pretty good. That's pretty solid. Yeah. All right. As part of the client's testing, or part of the testing client's property, plant, and equipment, the auditor determines it should verify management's assertion of existence occurrence related to fixed assets that were acquired over the past year. Which type of audit procedure would provide the most reliable evidence related to this assertion? Ooh, now we're getting into a little bit detailed about evidence. Okay, analytical procedures, would that provide the most reliable evidence? First of all, it is not a high reliability test. It's only medium reliability, okay? Secondly, what type of assertions can we test using analytical procedures? I promise I will get this into your skulls before this exam. VAA and completeness. Those are the only two assertions that can be tested using analytical procedures. Which assertion are we concerned with? Existence occurrence. So by any logic, can we use analytical procedures here? No, we cannot. So A is out. Inspection records and documents. Okay. Can we use this to test existence occurrence? Yes. Is it our highest reliability test? Probably not. Okay. Probably not. So let's go ahead and move on. Inspection of tangible assets. Is this a high reliability test? Yes. Does it test its existence occurrence? Yes. This seems like our most likely answer, but let's go ahead and move down. Recalculation. Recalculation is a very high reliability test, right? It is. What's the problem? Only test VAA. Okay, so that's why we can't use it here. So C is our answer. Consider the phase of the audit test or audit testing listed below. An auditor decides to send confirmation to a sample of client's vendors in order for the test or reported account balance or account payable. During not with which phases of the audit is the auditor most likely to conduct this testing? So when can we use confirmations? All right, so let's go through each one. Risk assessment. Can we use confirmations during risk assessment? Answer is no. We can use 4 types of evidence during risk assessment. Inspection records and documents, observation, inquiry. What's the 4th one? Not everybody wants. You're overwhelming me with your activity here. Getting overwhelmed. I can't hear anybody because it's so loud in here. Preliminary analytical procedures. Preliminary analytical procedures. Okay. So confirmation was not among that list. All right. Test of controls. That sounds pretty reasonable, right? Confirmations can never be used as a test of controls. That's my one big pet peeve in this entire course. If you ever tell me a confirmation is used as a test of controls, I will say you're wrong, and I'll throw stuff at you, even if it's only fictitious stuff. Just imagine that if you answer that, I'm throwing things at you in my mind. So remember, test of controls, inspection records and documents, observation, inquiry, reperformance, and walkthroughs. Those are the only types of evidence we collect. So we have substantive procedures. Can we do confirmations during substantive procedures? Gosh, I hope so. That's the only one left. Answer is yes. Remember, confirmations are a test of account balances. The only time we test account balances during substantive procedures. So the answer is D, 3 only. All right. So we got an analytical procedure here of Sally Seidel, who's preparing analytic to develop an expectation of previous year's sales revenue for a client, the Broken Arrow Performing Arts Center, which is actually where my home works. Yes. Yeah, test of controls, inspection records and documents, observation, inquiry, reperformance, and walkthroughs. So yeah, BAPAC, Broken Arrow Performing Arts Center. My mom actually works there. She volunteers because she's retired now, but she volunteers. And so this is inspired by her. Love you, Ma. And so she's developing her analytical procedures, which I'm not sure she actually has ever done that before, but yeah, there's the case. So price per seat, 100% seat sold, so it's divided between. So all we have to do is we have to take 2,400 divided by 3, 800. 80 times 800 is 64,000. Then 80% times 800 is 640 times $40 is 25,600. Then 60% times 800 would be 480 times $25 is 12,000. Add all it together, we get $101,600. At 10 shows last year, what would the expectation be? It'd be 101,600 times 10, which is 1,016,000. Everyone feels good about that? Good. It's an analytical procedure we haven't done before, but it seems pretty intuitive. I feel pretty comfortable about that. All right, let's talk about the audit risk model. All right. So you've been working in the auditing assurance service group for Amos Shaniwa Eisen and Otero LLP for the past 5 years. As an acknowledgement of all your hard work, the partners promoted you manager, responsible for training the new associates. Following your promotion, you meet with a young new associate named Ryan Jackson. Ryan is eager, intelligent, hardworking. How he tells it, he's prioritized learning about taxation during college and to retain much from his auditing course. They don't have much in the way of fundamental auditing concepts. As part of your training, you decide to refresh Ryan on the components of the audit risk model. So 4 components of the audit risk model. What are they? I'll give you a hint. One of them is in the name. Audit risk, okay? What are the components of audit risk? Inherent risk, control risk, detection risk. Good, okay. So what is audit risk? Audit risk is basically that type 2 risk that we talked about before, where we say that the auditor mistakenly expresses a clean opinion on materially misstated financial statements. So we basically say the auditor says that there's no problem when in fact there is a problem. That's what you want to say for audit risk. Not necessarily those words, but something along those words. Say the auditor expresses a clean opinion on materially misstated financial statements is technically the correct verbiage. All right. So that risk is comprised as a function of 3 other risks: inherent risk, control risk, and detection risk. Now, inherent risk, how will we characterize inherent risk? We safe to say that inherent risk are the fundamental risks of an entity's operations. Like going into business, you get exposed to certain risks just by going into operations, okay? What do we talk about in this course, or what do we do in this course? What did many of you do in this course that was a representative of inherent risk? This? Yeah. Inherent risk saying, yeah, that was really, really hard, Dr. Barnes. It was a really, really hard exercise. It was intentionally hard. It's supposed to be fundamentally difficult. That's inherent risk. But we have responses to risk. What are those called? Controls. A company implements controls in response to risk. However, we know that the controls themselves could fail for any number of reasons. So there's risks associated with controls. So we want to make sure that risks that control, we understand control risk, which are risks that are still present after an entity has taken action to address its inherent risk. Keep in mind, when we talk about control risk can actually take a number of forms. Control risk can actually be represented by whether or not the controls are properly designed. And there's also the concern that controls could be designed properly, but they do not operate effectively. This is not relevant to this question. This is just more reference for you guys to think about as you're preparing for the exam. Okay. So we have concerns about the design of controls as well as the operating effectiveness of controls. That would represent a control risk. But once we assess inherent risk and control risk, then we can determine detection risk, which is basically the risks that remain after planned audit procedures. So we determine what risks remain. Here are the procedures that we're going to put in place. Anything that's left is remaining risk. We want that to be sufficiently small. We cannot eliminate all risk entirely. Why not? Because to do so is impossible. Remember absolute assurance? Absolute assurance is not something we can accomplish. What are we shooting for here in an audit? Reasonable assurance, okay? So detection risk is trying to get remaining risk to a sufficiently low level. By the way, what is the relationship between risk and material misstatement? And actually, did I talk about that? That may be another question. Yeah, we're going to talk about that more in a second. We're going to get down to that in a little more detail. Okay, let's go ahead and do some breakdowns here. All right. So for each of the scenarios below, identify which component of the audit risk model the scenario most closely relates to. The good news is if you defined each of those components of the audit risk model well, this should be cakewalk, okay? So CapCorp has inadequate supervision and review over petty cash transactions. All right, so adequate supervision and review sounds like control to me, don't you guys think? So if there's inadequate, this represents control risk. Control risk, part 1, yes. Audit engagement team for Rosen Incorporated did not perform confirmations testing over Rosen's receivables. As a result, the auditor failed to identify a material misstatement in accounts receivable. Sounds like that they did not conduct their work properly after assessing what work they needed to do. What does that sound like to you all? That's detection risk. That is detection risk, okay? They did not design appropriate procedures to address any remaining risk. As a result, they did not identify a material misstatement. Because its business model requires that carries large quantities of inventory, E&L Enterprises assets are susceptible to theft. So this is their business model, and their business model is susceptible to risk. What type of risk do we call that? Inherent risk. That's inherent risk. Yes, very good. Halter Technologies operates in this industry where it's highly competitive and subject to rapid change. That also sounds like the entity and its environment. What is that going to be? That's also inherent risk. That's also inherent risk. Although the audit engagement team for Go Corporation was not able to obtain sufficient appropriate audit evidence to justify conclusions, the auditor issued an unqualified opinion. So effectively, the auditor issued a clean opinion on material and misstated financial statements, or possibly material and misstated financial statements. What does that sound like? That's audit risk. That is audit risk right there. All right. What 2 components of the audit risk model comprise risk and material misstatement? We already talked about this, but just as a refresher, tell me what 2 components are there? Inherent risk and control risk. Okay. Which component of the audit risk model is the only one the auditor has control over? Now, you could argue that there's two. You could argue that audit risk is one the auditor has control over, which is a correct statement. Okay. And if you made a sufficient argument on this practice exam, I might nod my head and say, that's a point. Okay. But I'm specifically referring to the one that is not a constant. Okay. Which is the one that's not a constant that the auditor has control over? Detection risk. Okay. Detection risk. So you need to briefly explain the relationship between this component and the scope of testing the auditor must perform as part of substantive testing. So we know that risk of material misstatement dictates detection risk. If risk of material misstatement is high, what is detection risk? Low. There's an inverse relationship. Do we like low detection risk? No. Low detection risk means we have a low tolerance for risk. As a result, we have to do more or less work during substantive testing. More work, okay? So risk of material misstatement is high, detection risk is low, work increases, okay? Let's flip the script. Risk of material misstatement is low. They've got great controls. What does that mean about detection risk? Detection risk is high. What does that mean about the amount of work that you have to do during substantive testing? Low, less work, happy auditors. That's ultimately what we're trying to get to. By the way, I didn't have an answer key up here, but the answer key is on Brightspace now available if you missed any of the answers and want to review that. All right. With that, I will be in office hours most of the day tomorrow. If you have questions, you can shoot me an email. If you need to set up an appointment, you can set up a Zoom call, whatever it is. If it's outside office hours, whatever it is. By the time the exam comes around Wednesday, it's too late to ask any questions, so take advantage of the next 47 hours. Have a good day. I'll see you all then.